Welcome everybody. Thank you for coming out tonight. I'm Sean Houghton. I'm the director of the Daniel and DiLella Real Estate Center. Center for Real Estate is the proper name. And I want to kick us off. I just want to tell you a couple of things about the center before we get our panel started. This is really our first full semester. You have some of our students sitting out there with you, so if you're right or left, you see a really young face. One of our undergraduates probably in the back row back there. The center is really focusing right now on undergraduate education and outreach to the industry, and we're trying to kind of wed industry and academics together, so we're really focusing on that. And I wanted to give a public thanks to Dan because you can give your money and not give your voice, but he's actually given us his time. Everything I've asked of him, he's done more than that, so I really want to give a public thanks to Dan, and also to Steve McCraney, who's going to get introduced later, but this is all on him, so drinks are on Steve tonight, so we really appreciate it.
What does the developer do? He buys drinks, right?
So without further ado, we're going to get started. I'm going to bring up Jim Danko, our dean, and he's going to introduce, talk a little bit about the SB and introduce.
I won't talk too much. So we've got a distinguished panel here, and we want to turn the program over to them. But I just want to take a minute too to welcome everyone. It's great to see a combination of students and alums and guests from the area. So we appreciate your coming out tonight. I want to add my thanks to Sean. I want to thank Dan and Steve for his generosity as well with respect to supporting us. There certainly has been, if you haven't been paying attention, I'll just mention to you, there's been incredible momentum at the business school of late, and we're very proud of that. Certainly great to know that our business school has been ranked. Every one of their degree programs now is in the top 25 of Business Week. A lot of external recognition. And really what underpins it, though, is the educational side. That's really where it comes together for us. It's the strength of Villanova. And we've been doing more and more of these events, and having the opportunity of having a center such as the Real Estate Center and having alum supported, as has Dan, it really gives us the opportunity to bring to life what we're talking about in the classroom, and to really connect theory with practice, provide us an opportunity with our students to get engaged in conversations like this that are so relevant and of interest to folks right now. So we're really pleased to have an event like this. And I want to thank Sean for his leadership of the center, and for Tim Hoffman as well. Jim VC, who's also involved in the center. So this is a brand new center for us. In fact, it's less than a year old officially. And with that, I want to introduce the person that really provided us the lead gift and a lot of the ideas. I got to know Dan. I think he was one of the very first people I got to meet when I came here as dean back in 2005. And Dan, rightfully so, kept pushing the agenda of having some type of a real estate program at Villanova, and the more that I got out and talked to alums, we found a number of successful alums in the real estate area throughout the entire kind of Northeast and elsewhere. Steve happens to be down in Florida, so we had a lot of alumni momentum. We had a lot of student interest in having more real estate courses here. In fact, there was a self-started student association around real estate, which quickly grew to 50 students. So you had the interest, you had alums, and certainly we have faculty that are very interested in the topic. So with Dan's financial support, which we needed, we were able to officially launch the Dan DiLella Center for Real Estate. And with that, I want to introduce Dan. He's going to be the moderator of today's panel. Dan is a 73 grad of the VSB. He is president and CEO of BPG right here in Philly. He's been a past president of the Union League of Philadelphia, and a great supporter of the business school. So with that, I'm going to turn it over to Dan.
Thanks, Jim. Dan's the easiest part of the job tonight. I'm going to be the moderator. These are the experts right here. And what I'm going to do is try to set the stage for what's going on in the real estate industry today, the way I see it. Now, each of these panelists are actually going to go more in depth of some of my comments, and I think you'll find them pretty smart people. We took our jackets off, so we look like we're being casual, so you'll talk to us. The whole point here is to have engaging conversation, ask questions. Don't hesitate to ask a question when someone's talking or presenting something. If you want to go in depth more, I'll try to come up with some of the questions myself, and at the end, we'll certainly open up the floor. The way I see things. Commercial real estate, I've been through 4 downturns in the marketplace. This is my 4th. I started in real estate in the mid-'70s, and that was the first crash I spent 10 years at a bank working out real estate problems, and life went on from there. This is a crash that's totally different than anything I've experienced, but every time somebody says, well, this is the worst ever, well, everyone was the worst ever. And frankly, what I'm going to end up on, the note that I'm going to end up on is that there are opportunities every time there's a problem. And I think that's the theme you're going to hear from several of the people here as well. But this one we didn't create. In the 1970s, the banks overlented the REIT industry. In the 1980s, basically we overbuilt. We had 35% pretty much vacancies and overbuilding across the country. In the late 90s and 2000, we had the tech bubble. Now the tech bubble, how it got to real estate was pretty simple. We were leasing space to phantom people. Remember, we had the tech people. They had six employees, and they leased a building for 100,000 feet for when their great new .com dog ID is going to happen. They're going to put 10,000 people in this building. They just kept leasing. We kept building. And there were certain parts of the country, and just like an example, Boston. Parts of Boston had 30% vacancies. We had a building in Cambridge. We went from charging rents of $50 a foot to be lucky to get 15, all in about 6 months. So that's how fast the market changes. And then, of course, there's what we're facing today. This is, again, a little bit different. We didn't create this one. What we did right on this one was, one, we didn't overbuild. Basically, the market is in equilibrium from a construction viewpoint. The second thing is that basically we didn't build for phantom space, so that was a good thing too. What we did do is over leverage, and I think Dave, who's going to talk a little bit about Volker's comments that we both heard last week in Florida, I'll let him take those comments that he made about the consumerism and spending, and had him run with that. But we certainly over leveraged our space. Commercial real estate, basically today, when I say they're over leveraged, if you have real estate today that is 80% leveraged, there were a lot of funds out there, a lot of individual assets that were leveraged at 80 plus, basically you have no value. That real estate now is worthless. It's pretty much gone. As a matter of fact, if you're probably down to the 70% range, depending upon the property, it's pretty much worthless. The transactions are off across the country, about 65 to 75%. Last year in New York City, just as an example, they did $51 billion of transactions. This year through October, there's been $17 billion of transactions. That's way off. The big problem is nobody knows what the values are because there's not enough transactions. Make it real simple for you. You're in a neighborhood, you want to buy a house, you make an offer on the house, the guy wants to sell the house, you have your house, you say to yourself, well, gee, I want to buy that house on today's prices, but he doesn't know what to sell it for, but I want to sell my house on what my neighbor got 2 years ago. Well, that's what's the problem. We can't set the prices, and the appraisers today are not being helpful. They're all afraid about being sued, and as a result, we can't figure out what the values are. Cap rates. Somebody's going to touch on this a little bit more in detail, but cap rates are up. I'm hearing about 50 basis points on A properties, probably 100 to 200 basis points on B properties, and I don't know where you go with C properties. That pretty much equates to a 10 to 30% reduction in value. Thus, if you're over leveraged, you have no value in your real estate anymore. Now, that's all the bad parts. Now, where are the good parts? First of all, there's billions of dollars on the sidelines today getting ready to invest in real estate. That means there's opportunities. And where are the opportunities? Well, of course, individual assets. You can always find the one-off deals. And I'll give you an example. About 6 months ago, we bid on a shopping center in Raleigh, North Carolina. It's 183,000 feet. We offered $34.5 million. Our retail person says that center sold last year or 18 months ago was probably worth in the low 40s. Well, we bid 34.5. We didn't get it. Somebody bid 36 or 38. 4 months goes by. Guy calls back on the phone and says, "I'll take that 34.5." I said, "Did I say 34.5? I meant 32." He goes, I'll call you back. Goes away for another 2 months. Comes back and says, "I'll take the 32. Well, a couple weeks ago, he said it's 29. He took it. As a matter of fact, and we're now, frankly, it came with debt as well. So now we're going to basically assume the debt and subject to the lender approving us, and we'll close on that transaction. So individual deals. Now, we're a fund manager, and what that means is we've coalesced funds from pension funds, endowments, foundations. Villanova University is one of our investors, and we put this money together, and we create portfolios. Now, if you have an over-leveraged fund today, and we don't, we're under 60% leverage on our portfolio, but if you have an over-leveraged fund today, and yesterday I spent some time with a consultant who represents some very large pension funds. I'm not going to tell you who the particular fund manager is because he told me who they were. They're in New York. They got a $6 billion real estate fund, and they over-leverage it to 90%. They have 65% first mortgage positions, and they have a mezzanine piece between the 65 and 90. This mezzanine piece is ready to foreclose on all the properties. They missed the payments. They went back to their limited partners, the foundations, the pension funds, and whatever, and the universities, and they said, we need more money, or we're going to lose this. Now, here's the problem. Here's the dilemma. Here's where everything starts to snowball. Basically, the university doesn't want to put the money up because they're afraid to throw good money after bad. That's number one. So now you got a bunch of large pension funds say, well, we'll put the money up. That dilutes the people who don't put it up. Then if you end up paying the new money a higher pref and giving them some preferences for taking more risk, now you're going to have lawsuits between the people who didn't put the money up or couldn't put the money up. So now this is all going to start snowballing. And frankly, I said, well, what are you going to advise? And he said, I don't know. I don't know where to go with this. And I said, well, it sounds like there's a lot of lawsuits coming, a lot of things starting to get stacked up, and that's exactly what's going to happen. Now, with all that happening, again, more opportunities. Then you're going to see mezz positions, mezz equity, you can see mezz debt. And then the last thing I think you're going to see is, I guess the big question is, when? When do you buy? 09, 10, 11? When you catch the falling knife is the term I'm hearing these days. And so if you catch the falling knife after you're trying to pick the knife up after it hits the ground, you miss the opportunity. In my opinion, you have to buy on the way down. So you buy, you don't buy exactly when the market's down, they're hitting the bottom of the market. You ride the market down a little bit. But this is a time for professionals, basically, to take risks, calculable risk, have money, have staying power, and work out the problems. But nothing, I haven't seen anything like this buying time since 91 through 95. The question is when. Now, all of these people here are going to tell us when, or get close to telling us when. We're going to learn how to finance it, we're going to learn how to buy it, we're going to develop it in Florida, and we're going to know what the banks are doing. So without any more than that, Scott Williams here. Scott each person is going to introduce themselves and tell us what they do, and then they'll give their presentations.
Thanks, Dan. Good evening, everyone. My name is Scott Williams. I have a few disclaimers before I start. I'm not an alumni. In fact, I think this is probably the first time I've ever been on campus. But since my boss is on the other side of the podium, I thought it'd be a real good idea to show up tonight. As Dan said, BPG Properties is a nationwide real estate investment company. We invest primarily in multifamily, office, retail, and industrial, pretty much nationwide. And we represent, I guess, it's over 100 investors now.
Yeah, over 100.
Over 100 investors in various funds. I thought, there's my cover slide. I thought just to give you a little real-time background, I'm going to address, I'm a borrower, so I represent the company in front of lenders. I represent the company in terms of loan relationships with our bankers, insurance companies, conduits, Freddie, Fannie. So I'm responsible for the banking relationships and all the loan lending that the company does secured by real estate. And I thought the first thing I'd do is show you a little actual numbers as far as what it's been like in the past few years. If you look, you can see in 2003 the company closed, these are loan closings by the way, we closed $823 million in loans in 37 different transactions. 2006 was $1.513 billion in 45 transactions. 2007, last year, we did $1.5 billion in 51 different transactions. This year to date, we've done $481 million in 16 transactions, and over half of them are refinances of loans that were coming due, where we decided not to sell into this market and refinance them with new debt. So you can see there's been a dramatic change in the market for financing for commercial real estate in the past year, and a lot of it is because the whole market has slowed down and the whole credit has slowed down in general. And so it's a good idea. We will probably by the end of the year we will not do half of what we did last year, even including the refinances. I don't have any good jokes, so I did put some quotes in here that I thought were good. I'm just going to concentrate on the second one on this because I think I'm first because I have the least number of slides and there's not a lot of numbers. So I'll just try to move through this. It is, of course, the nature of markets that capital should flow to where it is most needed. But the subprime market eventually pivoted on a quirk of need. It was the lenders, not the borrowers, who most needed the loans. This all had to do with people finding a nifty new product that they could sell, and they found a nifty new way to sell it. And at the end of the day, it wasn't such a good product after all because it caused a lot of losses. But the need wasn't the borrowers didn't need it, the lenders needed it because they could sell it at a profit. I wanted to give you a brief history of what it's been like as a borrower in the past few years. We've been watching this on the outside, for a number, we sort of watched the subprime crisis happen and said to ourselves, it'll never occur. It can't hurt us. It's a couple bad loans in California, can't hurt us. So let's see what happened. 2006, it seems like a long time ago, but it was really 2006 when the subprime really hit the fan. And it was in the winter of 2006 and 2007 when the rating agencies got called on the carpet by Congress because the rating agencies basically rated all this stuff as if it was good. And it turned out that some of it wasn't so good. So in the spring of 2007, the rating agencies, fresh back from getting their fannies slapped by Congress, start tightening up the regulations. And at the same time, the conduit markets and the United States commercial real estate markets were drooling over the idea that Equity Office was about to sell their entire portfolio to Blackstone. And Blackstone was planning on spinning off over half of that portfolio to outside investors. In fact, in Blackstone's due diligence, half of the packages were going straight to Eastville to make sale packages out of them. So you had this incredible concentration of commercial real estate finance that was going to happen in the spring of 2007 at the same time the rating agencies are tightening up the credit. So you can sort of see the iceberg and the Titanic getting together there. Summer 2007, the market seizes up. All of a sudden, the CMBS lenders can't sell their paper because basically what happened is the investors lost faith in the rating agencies because they had so many losses on the subprime stuff. They just decided, well, if you screwed me on the subprime, it's all bad. So we had a crisis of confidence. Investors stopped buying paper altogether, not just subprime paper, not just mortgage paper, not just commercial real estate paper, aircraft leasing paper, student loan paper, any kind of corporate securitized debt all of a sudden was poisoned. Insurance companies that do a lot of commercial real estate financing were totally overwhelmed because the conduits were out of the market. So their response was basically to just pick the easiest deals. They took the low-hanging fruit, 50% loan to value, safe stuff, real easy, and in some cases they actually bought some of the securities because it was easier than closing loans. Commercial banks stayed active. Early on, they were very perseverance, and they said, listen, we're here to help you. We know there's problems in the markets, but we're safe, we're good to go. You got a problem or something, let us know and we'll help you. And Fannie and Freddie, who are huge lenders, not everybody knows it, but they are huge lenders to the multifamily industry, were solid and very active in the multifamily industry. So winter, spring 2008, all of a sudden the crisis evolves into a valuation crisis. All of a sudden everybody realizes at the end of 2007, the accountants and the auditors walked into all these financial shops and said, well, what is this stuff worth? And people said, well, we really don't know. Well, then write it off. And what happened is, with marking to market and with a lack of transactions, all of a sudden these securities had no market value because no one would buy them. And under the mark-to-market rules in accounting, they had no choice. They had to write them all down. It was really some terrible times, and there was a lot of paper that was written down regardless of the fact that it still had value. I sat at a dinner 2 months ago with an unnamed bank, and he told me that they bought a CDO, which is like a fairly complex security. They bought it for $140 million. This CDO had 99 different tranches of payment order. So the safest, let's say the safest one was 99, and it had 99. So when the interest bill got in, the guy who owns the 99th tranche gets paid first, then 98, 97, until they run out of money. So if you're 1, 2, or 3, it's kind of touch and go there. They bought tranche number 97, AAA rated. As of today, it's on their books for $4 million. It's $140 million they paid for it. They've never missed a payment. It's on the books for $4 million because there was no market. No one would buy it, so they had to write it down. That's what we're seeing here is a lot of this stuff out there isn't bad. It's just unsaleable right now because no one's going to buy it. And it's really created quite a problem. Commercial banks became distracted all of a sudden at the beginning of the year. The OCC showed up at all the banks and started asking questions about their real estate portfolios and their commercial portfolios. And all of a sudden, what used to take a week through a commercial bank took 2 weeks, and took 3 weeks, and took a month, and they're just totally distracted. Some of them still have money, some of them are still out there, but everything takes a lot longer than it used to. Fannie and Freddie were still out there making multifamily loans, and God bless them. The summer, we saw what happened in the summer. All of a sudden, the banks stopped making loans because nothing paid off. They had these huge portfolios on their books, and there was no roll because there were no permanent lenders to take them out. They had these huge portfolios of commercial real estate loans. They couldn't take anymore. They couldn't sell what they had, and all of a sudden the commercial lenders started cutting back because they just couldn't take any more loans. We had one lender, we paid off a loan in September. He said, "Thank you, that's the first payoff we've had on a commercial real estate loan since March." So, they were just stuck with all these loans, so they had to stop lending. Write-downs continued. We all saw what happened. All the write-downs, runs on banks, Bear Stearns, Lehman, Wachovia. We saw it happen. The cash was leaving. People were making calls on them, and there's no cash to pay them, and you can see what happened. Freddie and Fannie were still out there making multifamily loans, which is a good thing for us anyway. September, you saw what happened. Complete meltdown, complete freeze-up. Not only here, a global freeze-up of all trade, of all credit. And that's when the Fed jumped in and tried to take a look at straightening things out. Huge, massive infusions of capital. The whole concept behind the TARP program was for the Fed to go out and buy some of these securities, not so much to get them off the bank's books, but to create a real market value higher than having no value at all, so some of these institutions could write those assets back up to a more realistic number than zero. We'll see how that happens, because that hasn't happened yet. So where we are right now, there are no large loans. I think one of the things Dan's point was in New York, they went from 50 billion to nothing. Well, there's no small loans in New York. Everything's a big loan, and if you can't do a big loan, there's nothing to do. But I was talking to a lender. He said, we used to do $200 million deals. We'd take a piece and we'd get a bunch of lenders together and we get the whole thing done. He says, now you can't do 100, and I can't find lenders to take the pieces. So right now we're still in this period of time where credit is pretty well frozen. We're starting to see some loosening up, but we'll see what happens. There are limited transactions. There's just not that much happening between. There's not as many sales. There's not as many players in the market. I was on the phone with a mortgage broker we know in Washington, D.C. yesterday. He represents a lot of institutional lenders, a lot of life companies, and he said, I feel like I'm in high school. I've never had to ask so many people for a date, and they all say no. So it's really tough trying to find lenders out there. We're seeing tighter underwriting, lower loans to value. What used to be a 75% threshold is now a 50 to 60% threshold. Tighter underwriting, higher debt coverage ratios, more scrutiny of the borrower, more scrutiny of the people behind it. Extended processing time, everything takes longer. And the appraisal issues, we're running into problems where every appraiser now is trying to be conservative because he doesn't want to be the one that gets sued by someone in the future. And they are just, they're really very tough. And if they can find a way to kill the value, they are. So it's kind of a tough situation. Where we're headed, I think you're going to see the commercial bank. I think you're going to see that the commercial banks are going to stay distracted through 2009 between the credit monitoring and the mergers they're going through. I think you're going to see not much out of them for the next year. I think we're going to see the rating agencies are going to get regulations, and I think you're going to see a firewall put up between the issuers and the raters, similar to what happened the last go-round. There was a law passed called FIREA, which basically put a firewall between the banks, the lenders, and the appraisers, so that they became an intermediary that dealt with the appraisers. But if you were a lender, you weren't allowed to talk to the appraiser to make sure you didn't pony with the numbers. I think you're going to see the same thing happen with regulators going forward, where there will be firewalls between the issuers and the regulators. Interesting quote from the CEO of Moody's. We drank the Kool-Aid. I guess he's admitting that they really screwed up on that one. The story of credit rating agencies is a story of colossal failure. And what happened is the rating agencies screwed up on subprime, and then they lost total trust in them, and that started the crisis in confidence. Where we're headed, I think the CMBS players are going to need to reestablish confidence with their investors, and I think they have to do that by putting skin in the game, meaning they can't sell the whole thing. They have to retain a risk position in their deal, because every time we've seen lenders with an opportunity to work for commission, to work for stock options, or to get paid on volume, we usually have a crash. And I guess they're going to try to avoid that next time by, if they have a real risk position in the deal, they're going to think twice about their underwriting. I think insurance companies are going to run out of low-hanging fruit and will come back in the market. We had some good news today. A major life company just said we have too much cash, we got to get back in. So we actually heard that a major life company is getting back in the market. Tough terms, 50, 60%, 7% floors, but they're going to be back in the market, and that's good news. A couple things on just putting the skin in the game. Another alternative would be for securitizers to retain at least 10% of their own issues, taken from the lowest ranking tranches. Greenspan now says he favors strengthening the regulatory structure. As much as I would prefer it otherwise in this financial environment, I see no choice but to require that all securitizers retain a meaningful part of the securities they issue. So I think you're going to see the CMBS guys keep a little skin in the game. We'll see what happens. The one thing about the CMBS market from those slides, I think you're going to see the rating agencies get regulated. I think they're going to require that the issuers keep some risk positions in the deals. The structure will get passed. The issue is whether or not the issuers feel they can make any money doing it. Because all of a sudden, if they have to go through this with a rating agency, if they have to keep a risk position, that also means they have to set up a reserve on their books for that risk position. And it's going to be a case of whether or not they think they will be able to get back in the market and make money doing it. So the jury is still out whether that will happen or not. But I think that the mechanics will be in place for them to do it if they want to. I think you're going to see accounting rules are going to be amended to allow for more reasonable valuation methods, because the mark-to-market has created a huge problem in this country, and I think it's slowly coming out, and I think some people are already talking about trying to ease that up a little. I think the credit default swaps market is going to be regulated more like the insurance industry it really is, where these guys issuing these credit default swaps are going to have to set aside reserves for the bad days as well, because, you know, when you have a $60 trillion industry that is bigger than the GDP of the United States, I mean, something's crazy there. The current root of the meltdown isn't the result of too much regulation or too little. The root cause is bad regulation. Call it the revenge of Enron. This is the mark-to-market. Enron created a lot of this because of how they screwed things up, and the mark-to-market swung the pendulum too far, and now the entire financial industry is paying for it. I'm going to skip the middle one. A few years from now, there will be a magazine cover with someone we've never heard of who bought all those mortgages and derivatives for next to nothing on the correct assumption that they were indeed worth quite a bit. This is from the former chairman of the FDIC. If we do not halt the insanity of forcing financial firms to mark assets to a non-existent market rather than their realistic economic value, the cancer will keep spreading and will plunge the world into very difficult economic times to come. And we can see that that's sort of happened. And so hopefully we'll get some relief there. And lastly, where we're heading, we're seeing Freddie and Fannie, even though they're national now, they've come out and they've announced they're going to continue to support the multifamily program. We think it will happen for a while. We think once alternative sources of financing show up, we think they will stop lending and they will try to shrink their portfolio. But for now, the good news is they're there, and that's pretty much supporting the multifamily industry right now. And the bogey in the whole thing is the economy. To the extent the slowing economy slows down, everything you hear tonight about how long it's going to take to get through that, just add some time to it. But on the good note is we've seen big changes in short-term interest rates. LIBOR has plummeted. Rates are coming down. The cash is getting back out there, and we're kind of confident that hopefully some economic stimulus programs are going to come out and things will improve in the short term.
Thanks, Scott. Before you get into Mike Jones, I want to make an observation just for some of you younger people here. I had someone asked me a question a couple of weeks ago. Well, let me go back. When I was a young banker and a young player in the real estate market, I used to sit there and go downtown Philadelphia and see all the old developers and the old bankers. And you would say, gee, when are these guys going to move on and let the younger people move up into the marketplace? Well, you're going to see that now. The younger players today, and some of you're going to see fund managers disappear. You're going to see bankers disappear. You're going to see brokers disappear. You're going to see developers disappear, and we're going to shuffle the deck. That means there's going to be opportunities for a lot of the younger people, the middle management people to move up. There's going to be a whole reorganizing of who the players are in the next 5 years. Great opportunities. It's time to clean out something, change it. Everybody overplayed their hand. So this is where all of you young people or people who are just in real estate or even in real estate for 10 years, it's time to move up into that marketplace. Next speaker is going to be Mike Jones. He's with Deutsche Bank.
We planned it so that the investment banking guy would follow Scott. I'm an 85 grad. I run securitized product sales at Deutsche, and wanted to take you through, and I will shorten up a couple of the pieces here, but I want to thank Dan for his leadership on the program. It's a great initiative, and also Tim and Sean and the Dean for arranging this panel. I want to talk about some of the impacts on the securitization marketplace and how did we get here. When you look at the subprime crisis, we're in phase 57, but throughout the course of 07, mortgage problem, knock-on effects in other sectors within fixed income, whether it's leveraged loans, high yield, spill over into the money markets, and now to the point where corporates are having problems financing their day-to-day operations. When you look at the U.S. mortgage market, agency CMOs, agency mortgage-backed securities that can be guaranteed by Fannie, Freddie, or Ginnie Mae comprise 70% of the mortgage market, which is quite a large number. Non-agency securities, whether it's subprime, Alt-A, or prime securities, have grown tremendously through the course of the decade, but are nowhere near the size of the agency market. Now, we've heard about Fannie and Freddie and the role that they'll play. They will continue to play a very dominant role in re-energizing the mortgage market through the help of the government. Now, this is a slide that's kind of interesting. Subprime MBS is about 7% of the overall market, and you can see that agency mortgages make up about 45% of what is securitized. Whole loans, which are loans that are originated and kept on banks' balance sheets, are about 34%. Then in credit order, you've got prime, Alt-A, and subprime. Now you can see what's happened, and what I've done here is I've taken three asset classes basically within securitized products: subprime or home equity, RMBS, asset-backed CDOs, and commercial mortgage-backed securities. The high water mark, obviously, in 2006. You can see what happened to origination volumes to where we are so far this year, where origination is virtually non-existent. Now, the liquidity crisis, how did it happen? And I'm looking at this from the securitization standpoint. You have a situation where deals were being done and investment banks were unwilling to position new transactions. Credit was deteriorating within the securities on a loan level basis. Borrowers were delinquent on their payments, and investors were not willing to add to the positions that they already owned. The CDS market was an interesting development throughout this process. And synthetic securities within the CDS market were created. You could replicate an exact security. And what it did was it allowed hedge funds the ability to hedge risk that they saw. So, for example, if a hedge fund had a strategy in high yield or equities or levered loans, and they saw the U.S. housing market as a problem in 04 and 05, and they wanted to hedge those returns, through the CDS market, they could effectively short the U.S. housing market and protect those returns in their core strategy. CDO packaging by the street married those two parties. The hedge funds provided the raw materials, and the investment banks took those CDS contracts and used them as raw materials for CDOs. You saw continued credit deterioration from homeowner performance, late payments, and the deterioration in the performance of those securities, on top of liquidation, on top of additional selling from clients. As leverage was being taken out of the system, more selling, investment banks writing down positions, undercapitalization, solvency fears. Obviously, the Treasury's TARP program has been put in place to deal with the situation in the marketplace, and it's starting to take effect. Now, when you look at the impact on the commercial market, this is just a quick graph showing index values, and what the takeaway is: commercial property is up 90% from 2001. It's up 30% since 2005. It's down 12%, to where we are today. Getting us back to 2006 levels. When you look at the property types, apartment, industrial, office, and retail, you can see that the declines are pretty consistent. When you look at the Moody's information. Part of the problem with some of these transaction-based indices is that the fact there aren't enough transactions in some of these asset classes to give you good information. The securitization of the loans that have gone into CMBS transactions, conduit loans, conduit programs started by investment banks, there's a moderate amount of loans that are maturing over the next several years. So if you look at the slide, there's $18 billion in 2009. There's $32 billion in 2010. Obviously, 2015, 2017 roll along, and the market should be in a much better spot. One area of concern is that there are 5-year IO loans that are coming due over the next couple of years, which there may be issues refinancing those loans. So, question that's on everybody's mind, is commercial real estate the next subprime? When you look, we're talking about buying real estate, financing it on a leverage acquisition basis. Real estate needs to come down further to make it work for investors. When you look at REIT equity prices, they would tell you that the market's down 15 to 20%. When you look at these scenarios, most of the conduit loans have positive equity. They've got low LTVs when they're originated, 70 to 75%. Plus, you've got the price appreciation that we talked about on top of that. They're up 30% since 2005. So the expected price declines in commercial real estate are not enough to trigger defaults in an excessive magnitude. Now, part of the problem is what's the extended duration of the economic problem that we have, and that will be, that'll play out over the next quarter to 2 years as we go through this process. But when you look at data on commercial real estate downturns, and this information dates from 1980 to 2006, and it looks at completions as a percentage of stock. We don't have an oversupply issue. So from a fundamental commercial real estate standpoint, there's not an oversupply problem. So again, 15 to 20% declines over the next 12 to 18 months. Price declines alone are not going to be enough to trigger defaults. And obviously CMBS is going to be contingent upon the overall depth and deepness of the recession that we're looking into. So, just a quick word on the post-crisis landscape. Obviously, de-risking has happened. It continues to happen. Delevering is being forced on institutions that have used excessive leverage and have had complex balance sheets. The subprime crisis effectively started in the summer of 2007 when Bear Stearns Asset Management was forced to unwind, and that was mortgage related. And it's morphed and spread to other sectors within the marketplace. When you look at the competitive landscape for the investment banking community, obviously on the left is March 2008, what the U.S. institutions look like and where we are today. There's been forced consolidation, there's been bankruptcy, there's been Goldman and Morgan turning themselves into commercial bank charters. You've got a situation where you have larger institutions, cleaner balance sheets, less leverage. The marketplace is consolidated. There's going to be more regulation. Obviously, we've got a new administration. We're going to have a new Treasury Secretary. One thing that's worth noting, improved underwriting standards. The marketplace will not allow underwriting standards to continue as they've been. So we'll have improved underwriting standards. You won't see any more no-doc loans, zero down payment mortgages. And that's good for the marketplace. The programs that are in place are obviously all, aimed at the same goal, and that's to provide, bring liquidity back, restore the market to its more balanced, liquid state that we're used to. And that's it. I'm turning it over to.
Just a quick observation. I think you brought up a really interesting comment. What are the expected returns in the future for investors? And I've heard now they're all over the place. I mean, if you think about, you're going to now have much less leverage. You're not going to get those, the quote everybody running around for years talking about getting 20% returns, which I never really believed anyway. I don't know. You guys want to comment? Somebody here want to comment where they think the returns are going?
Right now you can buy AAA rated mortgage-backed securities with 40 to 50% credit enhancement without leverage. So you're just buying the securities for cash, and you can look at base case yields of anywhere from 15 to high teens. Asset-backed securities, home equity securities, subprime securities, anywhere from 1,000 to 1,500 over on a spread basis. So that's 10% as a starting number, and depending on the structure, anywhere up to 20%. And so one of the things that we're seeing is a massive amount of capital that is being raised and being deployed, sitting on the sidelines, but also entering the market to take advantage of these situations. And it's truly just a supply-demand mismatch, right? The capital that's there is waiting, it's being patient. The yields are there. Problem is that you do fundamental analysis on these securities, and you stress them out, and under your stress scenario, you can earn 15%, and in 2 weeks the prices are down 10 points. So you've got a technical problem. You've got a technical situation in the market that's overwhelming fundamentals. So We continue to see buying. The buying is coming mostly from institutions that have money that's locked up for longer term. It's not fund-to-fund, hedge fund money that's quick and moves around. It doesn't have short lockup. It's longer-term lockup money where they can ride out what you were talking about, Dan, from where we are now to the trough and then back.
We're starting to hear some of the LPs as well having a little bit of funding issues. And it's another one of those urban myths that you keep hearing about, these people saying that I know somebody who has a problem who has not funded on a capital call. And I said, who? And then it's always somebody's brother's cousin, uncle's, that we heard, but nobody ever tells me the name. So I'm not so sure it's real, but it's going to happen. It has to happen because they're having both the denominator effect and the numerator effect now. They have the values of their portfolios are down, and they're not getting the cash back from their managers like they thought they were going to get back. So we've got all these other issues. But now, as you say, which I don't even know what the returns are anymore. I don't know what people want, and that's obviously continues to be the problem. We're going to go to a pure developer next. He's a Florida developer, Steve McCarney.
You got this? Okay. I'm Steve McCraney. Thanks, Dan.
Close. I was close.
We were
Everybody
roommates.
knows me.
We were roommates in college. And, by 3 a.m. it was McCarney.
I had dinner at a restaurant last night. I called the guy Alberto all night. Angelo. His name's Alberto. And I've known him for a long time. He lived with it.
3 words. I'm going to give you a pure developer point of view that doesn't use outside equity, and it's interesting because these I am also a 85 grad, and your face looked the same behind a beer glass, but your hair was longer. But and it's it's really great to be here. Dan has done a great thing here, and I'm looking forward to the growth of the real estate program here at Villanova. Coming from Florida doesn't seem like it's quite so far because there's we have a lot of graduates from Villanova that are in Florida, but kind of coming through the ranks from here into New York, and then with CBRE for a number of years, and then with a couple of developers. I am now in my 20th year, my 19th year, going on my 20th year in business. And I was that guy that said, I've experienced a really awful recession, and I thought, God, if I just put one foot in front of the other, perhaps I could do it better. And so I was the one that started with, roughly a 20,000 square foot building that has grown into roughly a 2 million square foot portfolio today, predominantly of industrial product that is all Florida based and mainly in the West Palm Beach North markets through Orlando, and we're aggressively looking at Jacksonville and Tampa right now. But my interest isn't to do anything outside of Florida, because I think it's like the old saying, how many pieces of apple pie can you eat at a time, right? In Florida and pretty much in the Southeast, as it says, it began with housing. It'll also end with housing. And you've heard some incredible things here, and I'm going to skip through a lot of this because it creates a measure of redundancy. But the way we see it is, there was an immobilization of the credit markets, which has brought a huge reduction in equity, and driven investors to sell products to raise cash. Now, what always happens when people are selling product? They're, in a market like this, they're only selling their best product, so they're going to be left the ones that they can't sell, which creates some real issues here. Lack of liquidity drivers. Markets not yet reflecting the liquidity from government intervention. I was in Atlanta a week ago today, having lunch with the chairman of a large bank, who was my lead lender, and they happened to receive $3 billion from the government. And I said, how are you going to disperse this among your profit centers? He goes, he says, what the government really wants us to do is go buy out another bank. And that's not what I expected to hear, but I think that's what's going to be happening out there. Big impact in the Southeast from lack of equity funds, which represented roughly 60% of the of all investment. Sellers' values, as a number of these guys have shared, sellers' values expectations have started to come down. We started on a transaction in Lake Mary, Florida, which is just north of Orlando. And the deal started out at roughly 250,000 square foot office and industrial complex that we're under contract for right now. And as we've moved through due diligence, the price has fallen and fallen and fallen as the cap rates are being impacted. We talked to the seller today and said, we're gonna need roughly another $1.5 million off, and we'll go hard tomorrow with our deposits. And I'm ashamed to say that we got it. And so we're buying the deal at just off a 9 cap, and I'm not sure at this point, to your thoughts, Dan, if I'm making a good deal or not. Who knows where it's going? It's like a B-type product, and we'll see where that goes. But to move on, private equity investors can't exit at desired levels. Case in point, bargains are not easily found. Bottom feeders are emerging. And I'll share this later, but we think the biggest opportunity is coming, and we're looking at loan packages now, where we can buy notes at significant discounts from locally based banks within the Florida market. Companies with strong balance sheets and I would say relationships still have opportunities. The bells of the ball are going to be those that invest in their businesses now and wait for the market to recover. What I have said to my team is that this is not a year that's about profitability. I report to myself every morning in the mirror, but this is about getting from point A to point B, and those that survive, I think, are going to do it enormously well. I'll skip through that because this slide was pretty much slide. Obviously, it started with housing, subprime mess, rating agency downgrades. Keep moving here. Debt market snapshot. Economic weakness has generated a significant amount of higher default rates. It's exceeding historical averages. Rush to quality in institution lender sector, and the spigot continues to tighten. Lending standards are tightening sharply. What we're finding, though, is while those of us are worried about mark to market of any of our products, what we're finding is that banks are really not looking at technical defaults today. If you're hitting the payments, I don't think it's an issue. If you've got covenants that require you to hit a 115, 120, maybe 125 debt cover, the banks clearly don't want to take over our product. Keep rolling it here. Florida's kind of an unfamiliar territory. I always put ourselves with parts of California, parts of Texas. We're this great peninsula where land is continuing to run out, which always props up the value. I've many times looked to go into the Atlanta market, and I always turn back because you could do industrial space for, I don't know, $295 to $285 to $350 10 years ago. You can do that today. When I talk to large developers there, like Ray Weeks or the Duke guys or the Taylor Mathis group in Atlanta, they're doing these deals and they're getting in. It's cap rate and fee driven and getting out. Some of the other markets that I just mentioned, you can clearly stay in for appreciation. Economic conditions have generally been stronger in the Sunshine State. Last time we underperformed the nation was in 90 and 73. One thing that we have that many places don't have is the impact of hurricanes, which has given us huge insurance costs, huge real estate taxes, because after the hurricane, so much was rebuilt, and the local governments couldn't wait to get hold of that. Luckily, we've been 2 years without a hurricane, which has been terrific. My wife and I lost 2 roofs in over the past 5 years, so it's nice that it's settling down a little bit. Industrial vacancy rose sharply, in all the major sectors of Florida. Home sales appear to have slowed in their decline, and especially in Florida. I've got a typo there. It says the houses have fallen 20%. They've actually fallen now almost 32%. And the other issue has been the cost of living issue, which clearly is coming down in our market due to this correction. Other industrial economic pressures: slow consumption, a weak dollar. Vacancy rates increased 2.4 points over the past year. 09 and 010, we're looking for a great opportunity. And I think, when I wake up at 4:30 or earlier in the morning, and you're just kind of sitting there, it's not a worry about how are we going to get through this market. It's as Dan had mentioned earlier, it's when you're going to catch the falling knife. There's an equal opposite of that, and I've got a slide that matches it. And Dan, I've only got like 85 slides, so I'll be here in like 25 minutes. But it's kind of like, it's either catching the market as it's coming down. But let's remember that while you're using this catch the knife theory, we were talking about petting the frothing dog theory back 18 months ago, when there was so much exuberance in the market and people were lined up for it, and the opportunity is what is going to clearly come out of this. Some of the benefits we're going to see: the correction is boosting exports. So weak dollars created great value through Miami, Jacksonville, and Tampa markets. And the biggest part of this has been tenant downsizing. We have tenant after tenant coming to us through our portfolio. We are working out rents now. My staff attorney spends more time doing nothing but crafting deals that are payback deals. And you hope you're going to get them. You hope you're going to get the payback on it. But the whole point is to limp it through. Population growth has been the big driving force for us, including confidence in our market growths and capital sources. That's what's really being challenged right now. Vacancy has generally run for our product type about 10.5 points. You see what the distribution looks like among the major Florida cities. This is just an illustration that I wanted to show you, but this is just one example of one market within our state that vacancies continuing to climb, and rates are continuing to fall. Here's the thing that we've kind of been worried about is interest rate growth. And as you've all seen, if you're following it, any land debt that we have, and we don't have a lot of land debt. We've got enough land in-house right now to build roughly 1.7 million square feet. And very, very little debt on it. But even at that, I'm concerned about it. And some of the things that we're doing, and again, this is from a private point of view, is a couple of weeks ago when muni bonds hit probably their historical low in almost 20 years, we picked up a ton of them. And as a hedge for rent losses and vacancy loss. We've watched LIBOR settle down, because any of our land debt is LIBOR floater based, and what we're considering doing is going in and buying caps to say if LIBOR's down at like 183, 185 or something like that today, which is a dramatic change over the past 3 weeks, and if the government's printing $700 billion, how's it going to get paid back? Interest rates have to take off at some point. Inflation has to take off. And I'm led to believe that interest rates will follow. Where people have gotten just clearly nailed in the past is with that floating debt product. So our strategy is keep the portfolio defensive. We continue to revise our expectations down. We're looking for a slower recovery than we initially expected. We're watching for the higher interest rates. And financial institutions are still writing off product. In fact, we reviewed a loan package today, and the hedge funds have started to step in, and the hedge funds are out there at 50% of note value, which is just a phenomenal opportunity. Even when, have you seen any of this? It's incredible. And we picked up 2 loans today at two notes at roughly 65 cents on the dollar. So we are straying from our traditional product type, but we bought 2 buildings that were in the 60,000 square foot range apiece for, I'm ashamed to say, roughly $86 a square foot. And they are both brand spanking new buildings that have never been occupied. So what do we think? We think we're in the fight of our life. And the opportunity is to button down the hatch and to focus on the opportunity. And the opportunity is coming. The government, we think, is going to take about 6 months to get in gear. 09, 012, we're saying, we're thinking the opportunity is going to come out of high loan to value type deals, maturing debt, mezzanine issues. The basic fundamentals are what's in fashion for the private developer. Capital structures, solid values, watching your cap rate, hedging your spreads. REITs were trading roughly 15% over. You've seen a huge correction in a lot of the REIT stocks over the last 2 to 3 weeks. And before you were buying properties, we think now there's going to be a lot of loan buying. And as I say lastly on this is don't confuse volatility with common sense opportunity. We think it's, this is my favorite frothing dogs slide. Figure out which one's the developer and which one's the banker. But staying close to that banker, I think, is incredible. Our thoughts for survival are staying power is pivotal. Stay in cash, protect the downside, don't bet the organization, focus on short-term strategies, even with large tenants that are renewing. Now we're even doing transactions on 40 and 50,000 square foot deals and giving great deals for a 1-year basis, because this is about living to fight another day. Deleverage and consolidate, keep your corporate culture, and failure is not an option. But some of the opportunities, huge opportunities, are coming out of this. There are great people in the market right now, and we are finding with the layoffs that we are pulling in incredible people. You want to tell them about this one, Dan?
No, that would be you and your roommate over there. I'm not going there. That's you.
We think that there's great strength coming. There are demand drivers that we expect to be seeing over the next 12 months. Cost of fuel represents about 70% of supply chain costs. Fuel costs are coming down. Business will shorten distribution centers. You were seeing a lot of the major players going for the central big boxes, like the Walmarts and the Targets and you name it. We're seeing those start to re-break down into smaller territories, which I think is going to create a tremendous amount of build-to-suits, because we're starting to see them. More facilities and improved logistics management. Around our sector, we're also seeing global trade's expected to grow 5.5%. Air cargo is growing. Port volumes, TEUs, are really climbing in our markets. Efficiency of bringing goods to market is going to impact our space, and the greening of it. Dan, you made a great comment earlier. You want to share that comment that you made inside about greening buildings?
Yeah, I was at a conference where there was about 30, 35 investors, and now the new little trend is they give you a little hand calculator thing, and they ask a question, you get to push A, B, or C, and they give you instantly, you get the people, put the percentages of A, B, and C. And they said, how many people here would give up return to have a green building? 94% no. They want return before they get a green building. Now, building a green building today is a lot of common sense. You just do things that are right, and it doesn't really cost that much. You start getting a little carried away, it costs too much money, you don't get a return on it. But nobody in that room, whether they were universities, they were pension funds, they were big foundations, wanted to give up any return for a green building. So it's interesting.
Yeah, and I think the only place we're seeing it right now is with institutional funds, and I think what they're thinking is perhaps a quarter point plus or minus in value on the back end of a transaction. This is just to show you a quick segment. These are the kind of transactions as a private developer that we do in Florida. Now you see it's multicolored, but this is how we do industrial. This is the kind of industrial that gets rates. Well, they got rates a year ago of $11.50 to $12.50 a foot. We signed in this building right here, Train Air Conditioning, to 60,000 square feet in a 10-year deal with 3% bumps at $10.15 a foot. So, these are with roughly about 6% build out in it. So it's what I would call high fashion product for industrial. But I always have felt that lots of parking, strong FARs, great color when we can get it. If it doesn't give me price, it'll give me velocity. This is just another park. This is a 600,000 square foot project that we're planning on starting, all facing the Florida Turnpike in this coming April. But you see, this is all dock high product. The buildings are roughly 150 depth type product. But just because it's industrial doesn't mean it has to look like industrial. And it doesn't really cost any more to do it this way. It's just another. It's about a 315,000 square foot project we're waiting to start, and a large project in Orlando that we're planning. We do a segment of smaller office buildings that are just a 40,000 square foot project we build over and over and over. And this was a rehab that we recently did. But this is going to be a very interesting time. But I think what it really is going to be is as I said before, if we can all position ourselves right and really button down right now, this is clearly going to be the greatest opportunity of our lifetime. So my final thought is, it's a dog-eat-dog world out there, and I'm wearing milk-bone underwear. So thanks for listening. But this is all kind of tense information that comes out right now, and interesting times that keep us awake at night. But if we can't make a little light of it, I don't know that we're going to get through.
Thank you. Just a last comment. As I said earlier, there's always a winner and loser every time there's a product. If anybody here is a baby boomer who thinks they like to own a condo in Florida, I suggest you start thinking about it, because it's pretty cheap down there. Our next speaker is going to be Chris Henderson. He's with the Federal Reserve Bank of Philadelphia.
Yeah, how are we doing on time?
We're way over. I want you to know, I told everybody 5 to 8 minute presentations. I can see everybody listened.
And Chris, I was 4.5. Okay.
Okay, I'm Chris Henderson. I manage the Retail Risk Analysis Group at the Federal Reserve Bank of Philadelphia. My team is responsible for overseeing large bank progress towards Basel II from a retail perspective. But I see that there's some parallels between commercial, our CRE, and residential exposures. So I'm going to go through these charts very quickly because a lot of the panelists have already touched on things. But I just want to tell you a little bit about what I want to cover. I'll give you some background on CRE and CMBS, which we have largely covered. Some current market conditions and the potential risk to banks. More importantly, as a regulator, I'm more concerned about banks and the systemic risk to banks. So let's jump right in. Largely, commercial banks are holding these types of exposures. commercial banks in particular, but broker-dealers have another large chunk of it. As you can see, this has been growing quite steadily since '91. The CRE market lagged the residential market, so you see that there's a very sharp decline as at the end of '07. So lags and leads are very important in developing a story around systemic risk with CRE. If you look at one leading indicator, the NAR Commercial Leading Index, there's a lot of pain that's expected coming up in the next 6 months. This survey in particular is asking respondents to, well, basically of their assessment over the next 6 to 12 months. So with those two downturns, both in the first quarter and the second quarter, that's about a year's worth of deterioration in CREs. If you look at business sentiment for a 12-month period, a lot of these survey results are showing bear markets over the next 12 months. So if you look at the CRE cycle, I would think most people would say that we're in a contraction, although some signs, and the commercial land development sector in particular, is in a recession. So what I want to point out are some of these indicators and how they're trending recently, with more of an eye to supply and demand and cap rates to give you some sense of what's happening in the CMBS market. Office vacancy levels are rising. As you can see, there was a downtick in the late 90s. Then it shot up quite nicely in '01 to reflect the recession. So again, it's starting to turn up. So we expect office vacancy levels to continue to rise. Office rents are leveling off. As you can see, they're not declining yet. So it'd be hard to argue that based on this particular metric that CRE is in a recession, but it's definitely headed into some serious weakness. Cap rates are starting to edge up. So if you compare that to some mid-grade corporate yields, that would suggest that the values on some of these CRE loans, our exposures are going to decline further. You can look at the spread between these corporate yields and cap rates and see that there's a lot of weakness in the market. If you look on call reports, you can see that banks are starting to experience higher delinquency and charge-off, especially for those loans that are related to construction.
Is that all construction or residential?
That's just CRE, residential included. I think I thought I updated this chart. I guess I didn't give the updated slide. This is, again, just concentrations. Where are the loans? So if you think about a systemic risk issue, what we've been seeing through RMS is the large commercial banks undergoing some distress. If you see the concentrations for CRE, it now spills over into our community banks. So that is especially concerning for regulators, both OCC, FDIC, and the Fed. If you look off balance sheet, you're beginning to see that the CMBS delinquencies are rising. They're starting off from a very low level. So again, we're still in contraction mode as opposed to recession mode. But investors are responding quite sharply by requiring a higher yield of return on CMBSs. So you can see the yield of the spreads widening. And this is a global issue. This is not just a domestic issue. This is also a global issue. So you can see 2008 is starting off very poorly. If you look at a monthly U.S. CMBS issue perspective, you can see that after about June, it dries up completely. There's very little issuance in U.S. markets. And given that, there's also some further stress ahead of us due to the fact that a lot of the loans are going to need to be refinanced soon. So you can see there's about 4.1% of CMBS that's outstanding that needs to be refinanced in the next 18 months. Given the fact that credit markets are essentially frozen, that is not a very good prospect for this particular asset type. On top of that, you have the Federal Reserve Board showing survey response that a lot of the domestic banks are tightening standards on CRE loans. As you can see, this is very high relative to our last recession in terms of those number of banks that are intending to tighten standards. So what bank supervision tends to do is they tend to go out and to ask some of the banks within the district some survey questions about credit risk, risk management, MIS reporting, to get somewhat of a feel of where the stress is coming from. And some of the things that we determine in these surveys is stress testing is not happening at the portfolio level. So if you know that there is significant stress in the market and you're not stress testing, that's the problem. If you look at the snapshots and you see that trends are definitely negative, you should be doing some stress testing in order to get some sense around what types of required capital levels you need. Overall, the portfolios are riskier. There's one component of CRE that we're a little concerned about in particular, and that's interest reserves. Interest reserves is the payout to borrowers as they incrementally go through the project. The problem with that is that can mask some delinquency. So as regulators, we have to pay close attention to that. Again, some banks are not factoring in concentration within their ALLL methodology. So again, it's a capital issue that regulators need to be concerned about. Here's a little bit more detail on interest reserves as the potential to mask problems. If a borrower is not able to service the debt and the lender continues to advance funds, that is one way to mask delinquency and to delay charge-off. So that is one particular aspect of CRE that we need to be concerned about that will filter into the CMBS market. When will the pain subside? Well, I think if you keep an eye on oil prices, that could be one way to get a sense of how this recession might play out in terms of how deep it is. If you look at theoretical work by Jim Hamilton, he did a great job in the literature by correlating oil price shocks with economic shocks or recessions. And if you can see on this chart that prior to a recession, those are the bars, you tend to have significant increases in real oil prices. So you can see these jumps both on a dollar per barrel basis. It jumps up quite nicely and it comes down after the recession. As you can see, the most current shock is significant. So as oil prices retrench, we would hope that the recession would not last as long. That there would be some mitigation of that economic downturn. So keeping an eye on oil prices is a very good thing. And to relate that to where we are in terms of this crisis, I laid out a couple of other scenarios where we had real oil spikes. And you can see in the last S&L crisis, where it was a big financial shock, oil prices were actually declining. So what the environment we're living in right now is one where oil prices are very high and we're in a crisis. So with that, I think keeping an eye on oil prices is probably the best solution, or one of the solutions to getting a sense of when CRE, CMBS performance will eventually come back. And then I think I'm wrapping up there.
Okay, just a quick question for you. Do you think that the banking crisis is more prevalent in the regional banks as opposed to the big guys?
Yeah, that chart that I had out there with commercial banks or community banks, they have a lot of concentrations there. Now, the big banks have more capital in order to sustain some of those losses as well as some of the delinquency. So I think the bigger problem lies with regional banks and community banks.
Is the Fed going to put pressure on them?
In what way?
To help them move along
Well,
and become part of a big bank.
Well, no, I don't think that is one solution. I think the TARP program is very good. Banks will have to line up for that, and in fact, they are accessing those types of lines right now. The problem is that it's a residential mortgage focus. It's not a commercial mortgage-backed security focus. So there will be some cherry picking on the part of Treasury in order, which portfolios do you buy up. So there will be some capital stacking and some tiering of institutions in terms of where to invest those monies.
Great. Our last speaker, who told me he was going to take all of our comments and wrap it up. He was going to bring it all together.
Tess, I told you I was going to sit down too, but I got to stand up. And I would ask everybody if you want to stretch out. We're an hour and a half into an hour and a half program, and I'm the last one left. So I'll go through this in hopefully the prescribed 5 to 8 minutes of time, and then we'll open it up for questions. My name's Dave Hartzell. I came up from Chapel Hill, North Carolina, where I'm on the faculty down there. And have been for 20 years. I'm a native of Wilmington, Delaware, born right here in Philadelphia, Pennsylvania, and I'm as proud as you are that we have the Phillies as the world champions. Last week, actually flew up for the Eagles' victory last Sunday against Atlanta, which was great. That always works well back home, and I got to stick around for the 10-2 victory at night, which was just about as good as it gets for me. And another thing, when I'm down there, they tell me I have a northern accent. When I'm up here, they always tell me I've got a southern accent. So you guys decide what it is. And I do appreciate that I stand between you and the drinks that Steve's going to buy. I'm going to sort of take this up to a little bit higher level in terms of maybe 30,000 feet looking down instead of from the bottom up. And it relates to a couple things that I've been involved with in the last couple of weeks. I was down at the Urban Land Institute conference in Miami last week, which was outstanding in so many different ways. But one of them was just the fact that everybody was talking about doom and gloom. It was one of the most depressing things I've ever been at. And I agree with Dan. I'll talk a little bit more about this in a second, in that, with this doom and gloom and everybody talking about how bad things are, there is great opportunity. And I think we're starting to see the cracks now in terms of some of the repricing and land deals that have sort of rolled back to into the marketplace at discounts, at least in our area, of 15-25%. The other thing that is interesting, hopefully you'll find it interesting too, I found it interesting, is sort of what is normal in the marketplace these days. I've got a friend who's developing a condo project in Chapel Hill, North Carolina. If you've ever been down there, it's not a big market. It's a tertiary market. This is one of the greenest buildings probably in the southeast. And it's been a long process of getting through sort of the greening stages and sustainability and hiring all the experts to the point where they got to this summer where they actually started digging the hole and it's coming out of the ground. They got a big crane there. And the guy who's doing it is made a ton of money about 7 or 8 years ago because he sold out of the .com boom at exactly the right time. And he made a ton of money. He wants to do something that's real good, which is when he got into the marketplace. Since then, obviously, the world has changed very significantly for him. When he first started talking to banks, and it was Wachovia, they were quoting him LIBOR plus 125, which is just a great number, especially when LIBOR's at 1.5. And he's thinking, man, it doesn't get much better than this. And they sort of dilly-dallied. We have a very supply-constrained market because of the regulatory stuff that goes on in Chapel Hill. And by the time he finally got ready to do it, it was to close the loan. It was about 6 months ago. And he said, and the Wachovia said, well, we're repricing. It's LIBOR plus 275 now. And he's thinking, oh man, that's a $60 million project. That's $1 million for every 10 basis points in interest costs, and basically, obviously, completely changes the nature of the returns that he was going to get. And then he started selling condos into the marketplace. This is a pure condo deal, and he realized as it was getting later and later, he wasn't probably going to be able to do that. So he started thinking, well, maybe I'll start converting them, making an apartment project instead of these condos, which is happening a lot. And he said, when I first started thinking about it, cap rates were were at 6.5%, right? And now he's starting to roll in and thinking about a takeout, and equity investors are requiring 20% or thereabouts if you can find one. And he said cap rates are about 8.5%. And he looked at me and he said, and when are things going to get back to normal? And I said, you know, Dan's been through 4 cycles. I've been through 3 cycles. And I think the question is, what is normal, right? Because if you look back over the long term of everything in real estate, from debt, from equity, from cap rates and whatever, what we've seen in the last 6 years is absolutely not normal. And what we sometimes do in the real estate industry is convince ourselves maybe that it's not a cyclical business, right? That we're smarter. This time it's different, you know, and all that stuff. And what I want to lead, I'll lead with my conclusions, which is good. This I will have other slides though, so don't get up and leave when I'm done this. Is first that securitization is a great thing. My first job was with Louis Ranieri at Solomon Brothers, which was fantastic. He sort of created the residential mortgage-backed securities market, and we built the commercial mortgage-backed securities market. 1987, we did the very first senior subordinated security, which was outstanding. It was fun sitting there trying to figure out how we could find these risk clienteles and whether we could find investors to actually do it, which we did. And ultimately, the tranching of risk is inherently a good thing too, because both of them sort of bring a more efficient flow of funds to the capital markets through to our asset class, which is real estate. The irony, and this is sort of one of the things that's lost in terms of what we're seeing out there now, is that securitization is supposed to bring liquidity and it's supposed to bring transparency. And just when we needed it the most, the market froze up, and we didn't have either of them, and everybody's now going back and blaming securitization, which is not necessarily, I don't think, the right thing, but it's how we did it, and it's related to the fact that everybody in the chain of securitization on the commercial real estate side had no long-term stake in the property or in the project or in the risk that they were involved with, which creates this moral hazard thing that we've all been reading about it. We are a cyclical business, man. We've had so many crises in real estate over the last 25 years, and you know, we all say, man, how did we get suckered into that thing again, right? Whether it's low required rates of return on equity because of tax incentives, whether it's low required rates on debt because we're just getting pumped with liquidity from lenders out there. We tend to often overprice real estate or underprice risk. And I'd argue that we've sort of done that. And again, the question is, what is normal? And when will we know it when we get there? Here's that, I'll just show some pictures. This is normal. This is the long-term cap rate across real estate from the American Council of Life Insurance from 1951 through 2000. And you know, you guys, some of you are my age, maybe a little older, roughly around my vintage. You know, when I was sort of cutting my teeth in real estate in the mid '80s, somebody would say, Dave, what's the cap rate in, you know, what's the national cap rate? What would you say? 10. Right, 10%. And it didn't matter, you know. It's in New York City, it's 10%. Washington D.C., 10%. Philadelphia, 10%. You know, maybe in Chapel Hill, North Carolina, tertiary market, maybe it'd be 13 or 14, right? And in general, you can see then it sort of became 9 for a little while, but then we went right back to 10. So it's between 9 and 10 over the entire long period of time, and I would argue that that is normal. Yes, this is not normal. And this is where we were. This is 2002. We're talking about 9.5% cap rates, which is roughly normal, right? And we sort of got down, and this is from C.B. Richard Ellis, Real Capital Analytics, down to 6.5%. And again, I'd argue that this is probably not normal, right? And what's normal, if you look at this, is from the National Council of Real Estate Investment Fiduciaries. This was sort of the era when we had way too low required rates of return on equity because everybody was buying up tax savings, right? Remember that? To buy up losses because we could depreciate for 19 years at 175% declining balance in some cases, and we overbuilt in the marketplace. And we thought, you know, well, gosh, how did that, after it was all done, we said, how did that happen, right? It was like getting hit by a train. And we brought discipline back into the marketplace until we started getting way too much leveraging in the marketplace, and we started having just way too low required rates, in my opinion, required rates of return on debt out there, because everybody was competing to try to lend you money, which was a great thing, wasn't it? There was just people coming, lenders coming, and 1.2 times debt coverage ratio didn't work, then maybe we'll go to 1.1. That doesn't work, maybe we'll give you an IO for 3 years, and that 1.1 debt coverage will be based on 30-year NOI instead of today's NOI. And if 75% loan to value doesn't work, maybe we'll go to 80%. And you had just a choice, and a huge choice of different funding terms out there, which led to the auction process that you were talking about, Dan, a little while ago. That project, I think it's the one you were talking about. I think there were 20 some odd bidders for that project. They take the bids in, and they pick 5 of the highest bids, and there's no ask price on these projects back then, right? Which is just a whole other concept that maybe we should have realized was a red flag. Pick the 5 to come at us with your best and final, right? And then it competes there. Maybe we'll just eke out a little bit more. And meanwhile, you got lenders out there, and we overpaid for property. There is not all of us, but lots and lots of people did, which got us down to these record low cap rates. This is normal. This is the debt side, right? Think about the difference between a AAA commercial mortgage-backed security and a BBB minus commercial-backed security, and there should be a premium in there. Historically, it's about 200, 250 basis points between the best piece of the security and then the last piece that's investment grade. This is from November of 1999. And again, I would argue that this is normal. This is from January 4th in 2007. And if maybe you can't see the bottom here, the difference between the BBB minus piece and the AAA piece was 72 basis points. Something's wrong there. We're mispricing the risk of these BBB minus pieces, which again are sort of rolling through the subordination. And I would argue, and I think we're finding this out now, that 140 basis points may not be quite enough to compensate us for the risk that we were taking there. And indeed, I'd say that maybe the 68 basis points probably wasn't enough in retrospect for the 68. But this is the weighted average cost of capital that investment banks were using when they were creating commercial mortgage-backed securities. If they're creating securities and selling on this side, and they can lend at something that's higher than this, they can make money. And without a stake in it, they're just going to do that all day long and all night long. I would argue that this is not normal. This is not normal either. This is where we are today. This is as of Halloween, and it's not a scary joke. This is JP Morgan's the source of this, where that same AAA that was at 68 basis points over is now at 647. Treasuries at 4%, 10.5% on a AAA security. We always think of we always thought anyway of our commercial mortgages being roughly a BBB sort of risk, right? And again, getting back to the question about where our equity returns, here's BBB, which is 3,300 basis points over Treasuries. Treasuries are 400 basis points, so BBB bonds, if you could trade them, are getting 37%. So what's your required rate of return on equity in these deals? Again, is equity riskier than debt? BBB debt? Again, arguably, and what we have, I think, is a tremendous mispricing of debt in the marketplace, which has completely frozen up our markets from a liquidity perspective. So what is normal? And again, I'd argue that it's somewhere in between here. The question is, when are we going to find it, or if we are ever actually going to find it? A couple of other things. This is just, again, sort of a difference that you can see. People. Anybody get the Sam Zell Christmas card from 2006? Did you see that? It was called "Capital Keeps Falling on My Head" to the tune of Billy Joe Thomas. There you go. That's an old trivia question there. We'll do that over beers. And basically, there was so much money in the marketplace looking for yield that these yields were just forced way down on the CMBS side until they weren't anymore. And we had all these events, again, we call it the spinach crisis, because all the subprime problems carried over to the CMBS market, just like spinach in New Mexico carried over to the rest of the world. And we had this huge differentiation between risks. This is not the price of risk for a triple B commercial mortgage-backed security right now. In fact, if you look at the implied losses of those triple B securities, it generates a loss of on those pieces of 32%, which is completely unprecedented in the marketplace.
What I don't get is, why don't you see any of this paper trading right now?
That's a good question. Maybe our paper trader might have a better idea, and I'll answer in a second. But,
I mean, you don't see the bottom part of the capital structure trade. You see the AAAs and then maybe some lower rated